Welcome back to the Deep Dive. We're here to cut through the noise, distill complex research, and give you the key knowledge you need.
That's right. And today we're tackling a really interesting one, Travelzoo.
Yeah, trading on the NASDAQ under ticker TZOO. As of recording, September 18th, 2025, the share price is sitting at $9.76.
And Travelzoo, well, it's historically been this sort of niche player, right, in the absolutely massive online travel market.
Right, but they're in the middle of this huge strategic shift right now, which is why we're looking at it. It's kind of forced everyone to take a closer look.
Exactly. This is what you'd call a classic story stock. It's really a bet on whether management can actually pull off a pretty tricky maneuver, especially when they're up against these giant competitors with, billions to spend.
But if they do pull it off, the potential reward looks, well, pretty extraordinary. Let's just put our conclusion right out there at the start.
Yeah, let's do it.
Okay, so based on our analysis, using I'd say, conservative intrinsic valuation model, we calculate the share price should probably be somewhere in the range of $18 to $26 per share.
That's a huge potential upside from where it is now, under $10. It really suggests the market might be deeply mispricing this thing.
But, and this is the big but, the reason it's likely sitting at $9.76 and not, say, $18 is because of this massive red flag right at the heart of the company.
It's a major conflict. On one hand, you've got the company's board authorizing and actually doing pretty aggressive share buybacks. That usually signals they think the stock's cheap, undervalued.
A classic bullish signal for management.
Right. But on the other hand, the founder, Ralph Bartel, who's also the controlling shareholder through his firm, TZOO Capital, he's been consistently and significantly selling shares, hundreds of thousands of them, throughout 2025.
Yeah, that's the ultimate say-do gap, isn't it? The company says buy, the founder says sell. That's the core dilemma we really need to unpack here.
Absolutely. It raises all sorts of questions about alignment.
Okay, let's start unpacking. We'll begin with Chapter 1, the business of the deal. Understanding Travelzoo's engine.
So historically, for like 2 decades, Travelzoo was, well, basically a global internet media company.
A pretty simple model. They made money, about 85% of their 2023 revenue, actually, by charging travel companies. Hotels, airlines, tour operators, advertising fees to get their deals in front of Travelzoo's members.
And they have a big audience, around 30 million members globally. But the problem was relying so heavily on that volatile digital ad market.
Which brings us to the pivot. This major strategic shift started in 2024. They're moving to a hybrid model, keeping the advertising, sure, but adding a paid subscription.
Yeah, a $40 annual membership fee. They're rolling this out in their main profitable markets first. That's the US, UK, Canada, and Germany.
And the idea is to monetize their biggest asset, which they argue isn't just the audience size, but the trust they've built with that audience.
Exactly. That's their unique selling point in this crowded market. You think about the big guys, Expedia, Booking.
Yeah.
You search for a hotel and you just get flooded with algorithmic results.
Wholly overwhelming sometimes.
Yeah. Travelzoo's pitch is different. They offer curated travel deals. They have actual human deal experts and even a test booking center that supposedly vets every single offer for quality and, importantly, real value.
So it's like a human stamp of approval.
Yeah.
We checked this out. It's legit. It's a good deal.
Yeah.
That's the value proposition against the algorithmic noise.
And interestingly, they kind of tested this model already. Back in 2020, they bought a company called Jack's Flight Club.
Ah, I've heard of them.
Yeah.
They focus on finding super cheap airfares, right? And it's a subscription service.
Exactly. And it's been pretty successful. So that acquisition basically served as the proof of concept, giving them the confidence, presumably, to try this paid membership model across the core Travelzoo brand.
Okay, so the core is curated deals, shifting to subscription. But they also have this other thing, Travelzoo Meta. What's that about? Sounds a bit speculative.
It is speculative. It's their venture into the metaverse, focusing on virtual travel experiences. You have to see it in context, though.
What context is that? Hedging their bets.
Kind of. Look, the online travel market is gigantic. We're talking, $745 billion now, maybe heading towards $2.2 trillion by 2033. It's enormous. But Travelzoo is still a pretty small fish in that pond, facing this massive duopoly of Booking and Expedia.
So the subscription pivot is defensive.
Largely, yes. It aims to create a predictable, recurring revenue stream, insulate them from the ups and downs of digital advertising, and monetize that trust asset we talked about. Travelzoo Meta, on the other hand, is probably a relatively low-cost bet on the future.
A hedge against technological disruption, maybe. Like AI getting really good at curating deals itself.
Precisely. AI is a key threat to their human curation model down the line. Meta is a small, calculated risk, a way to potentially tap into the experience economy if virtual experiences take off without betting the farm on it.
Okay, interesting. So if they're making these big strategic moves, who's steering the ship? Let's get into Chapter 2, the captains of the ship, evaluating management and capital strategy.
Well, one thing that stands out is the stability at the top. The global CEO, Dr. Holger Bartel, yes, related to the founder, has been with Travelzoo since 1999. That's rare longevity.
And what about their track record? Beyond just being there a long time.
It seems pretty solid, actually, and particularly how they handled the COVID-19 crisis. Instead of just, trying to tread water everywhere, they made a tough, rational decision in 2020 to exit their unprofitable operations in the Asia-Pacific region.
And did that pay off?
It seems so.
Yes.
It streamlined the business, and by 2024, their post-pandemic operating margins actually exceeded the pre-pandemic levels. That points to disciplined execution, focusing on profitability.
Okay, so disciplined operations. What about their investment strategy now with this pivot?
Well, they've done targeted M&A, like Jack's Flight Club we mentioned, and another small one, MTE, for the meta venture. But the big focus now is organic investment. They're putting significant money into marketing.
Trying to convert those millions of free members into paying subscribers, presumably?
Exactly. That's the critical task. And alongside that marketing spend, you see the other big capital allocation signal, those aggressive share buybacks.
Right. Since 2024, they've repurchased about 16% of their outstanding shares. That's about $11.5 million worth. That's a very strong statement from the board that they believe the stock is undervalued.
It absolutely is. But this brings us right back to that capital allocation contradiction, the glaring inconsistency.
Signal 1. Board buys back stock, aggressively bullish.
Signal 2. Founder and controlling shareholder Ralph Bartel sells aggressively bearish. Hundreds of thousands of shares consistently offloaded throughout 2025.
So how do you square that circle? Does it completely undermine the buyback signal?
It raises serious corporate governance questions. I mean, you have to ask, whose interests are being prioritized here? Is the buyback really the best use of capital if the main insider thinks the price is good enough to sell large blocks?
But couldn't he just be diversifying? I mean, after 20-plus years, maybe he just wants some liquidity for personal reasons. Founders sell stock all the time, don't they? Especially when the company's finances look good, like that ROIC figure.
That's the counterargument, definitely. And the financial quality is impressive. Their return on invested capital, ROIC, in 2024 was an exceptional 88.3%. That shows incredible capital efficiency.
So maybe the selling isn't a comment on the business, just his personal finances.
It's possible. But as an outside investor, when you see the person with the most information and the most control consistently selling into the company's own buyback program, it's hard not to see that as a potential misalignment. It suggests his view on the stock's value might differ significantly from the board's public actions. It's a major red flag you just can't ignore.
Okay, that conflict is clear. Let's dig deeper into the numbers themselves. Chapter 3. Financial analysis.
Right, so first off, context. Travelzoo is small fry in market cap terms. About $107 million market capitalization. A true microcap stock.
Revenue-wise, they saw a strong recovery post-COVID through 2023. Trailing 12 months, TTM, revenue is up about 3.5%. Steady, if not spectacular growth right now.
But what really jumps out is the profitability on that revenue. The gross margin is phenomenal, 83.3%.
Wow, that's high. Mostly digital business, low cost of goods sold, I assume.
Exactly. And the operating margin is also very healthy at 16.8%. This thing generates cash. TTM free cash flow, FCF, is robust at $17.6 million. For a company this size, that's significant.
Okay, but when you glance at the balance sheet, you might see a couple of things that look scary. First, negative shareholder equity. It's showing around minus $2 million. That sounds bad.
It does sound bad, but you need to understand why it's negative. It's almost entirely an accounting artifact of those aggressive share buybacks.
How so?
When a company buys back its stock, it reduces the equity account on the balance sheet. Because Travelzoo has bought back so much stock relative to its size, it's pushed shareholder equity into negative territory. It's not usually a sign of operational distress in this specific context.
Especially since they have cash.
Right. Crucially, the company operates with a net cash balance. They have about $10.4 million in cash versus only about $7.4 million in debt. So operationally, they're not financially strained despite the negative equity figure.
Okay, that makes sense. What's the second potentially scary number?
The current ratio. It's low, around 0.69. Normally, anything below 1.0 raises flags about short-term liquidity. Can they pay their bills?
But again, context matters.
Hugely. A big chunk of their current liabilities is something called merchant payables. This is basically cash they've collected from members for travel deals or vouchers that haven't been redeemed yet.
Ah, so it's money they owe to the travel providers eventually, but they hold the cash for now.
Exactly. It functions almost like an interest-free loan from their customers and suppliers. It makes the current ratio look artificially low, but it doesn't necessarily reflect a liquidity problem in the same way it would for, say, a manufacturing company.
Okay, so solid profitability, strong cash flow, and the scary balance sheet items have explanations.
Yeah.
How does this stack up valuation-wise?
This is where it gets really interesting. Travelzoo's TTM, price-to-earnings ratio, PE, it's currently just 10.8.
10.8. How does that compare?
Well, let's look at the big profitable online travel players. Expedia's PE is around 21.6. Booking Holdings is about 27.0. Even TripAdvisor is trading at 26.8.
So Travelzoo is trading at roughly half, or even less than half, the valuation multiple of its major peers.
Precisely. There's a massive valuation gap. It strongly suggests the market is pricing in significant risk, either execution risk with the pivot or competitive threats, or maybe that governance overhang we discussed. It seems to be largely overlooking the company's superior operating profitability and capital efficiency.
Which brings us back to that intrinsic value range you calculated earlier.
Exactly. That $18 to $26 range is based on assumptions like continued high single-digit growth, driven by converting members, but also using a fairly high discount rate, like 12–15%, to account for the micro-cap nature and these execution risks. Even with conservative assumptions, the numbers suggest significant undervaluation compared to the current $9.76 price.
Okay, so the financials suggest value, but the market price suggests risk. Let's explore that disconnect. Time for part 2, the market and the risk. We start with chapter 4. Market sentiment.
And here, the divergence is just stark. You've got two completely different stories being told.
Story number 1, Wall Street analysts. They seem overwhelmingly positive, right?
Very bullish. The consensus rating is basically strong buy or buy. Their average price targets are clustered in a range that implies, well, over 120% potential upside from the current price. We're talking averages around $21.50 to $25.25.
And some are even higher.
Oh yeah. Litchfield Hills, for example, has a target way up at $35 per share. The analysts are clearly buying into the membership strategy pivot as a major growth catalyst.
Okay, that's the bullish Wall Street view. What's the bearish view, the one the market itself seems to be expressing?
Well, you just look at the price action and other market indicators. First, short interest. Somewhere between 5.3% and 6.5% of the available shares, the float, are being shorted. That's a significant number of traders actively betting the price will go down.
They're betting against the pivot, presumably.
Or on the competition crushing them, or maybe that the insider selling is the signal to follow. Second, momentum. The stock is currently trading below both its short-term 50-day moving average, which is around $10.75, and its long-term 200-day moving average, which is up in the $12.50 to $14.90 range.
So technically it looks weak. The trend is currently down.
Exactly. The market action, the price, the shorts, they're all telling a story of skepticism. They're pricing in a high probability of failure or at least significant near-term headwinds and profitability pressures from this transition. It's the financial models versus the street wisdom, essentially.
And who actually owns the stock might influence which story wins out.
Sure.
Let's look at chapter 5, ownership structure.
Okay, so institutional ownership is pretty significant. Big funds own about 44% of the outstanding shares.
Any recognizable names?
Yeah, names like Ocho Investments, Renaissance Technologies, a big quant fund, BlackRock, Vanguard. So there's definitely sophisticated money involved here.
But what about insiders?
Insiders collectively own a large chunk too, somewhere between 36% and 43%. But the absolutely critical piece here is that Travelzoo is officially designated as a controlled company, meaning one shareholder controls enough voting power to dictate company policy. In this case, it's the founder, Ralph Bartel. Through his investment vehicle, TZOO Capital, he controls approximately 55% of the voting shares.
55%. So minority shareholders have very little say, really.
Practically none. Investing in TZOO means you are, like it or not, a de facto junior partner with the Bartel family. Now, that can sometimes be good. It can shield the company from short-term activist pressure and allow management to focus on the long term.
But the downside.
The downside is that your interests as a minority shareholder might not always align with the controlling shareholders' interests, and when you see high volumes of insider selling.
Yeah, you mentioned over 1.4 million shares sold by insiders in the last year.
Correct. And virtually zero insider purchases. When that selling is coming predominantly from the person who controls 55% of the votes, well, it hammers home that potential misalignment we keep circling back to. It's the strongest signal contradicting the company's own buyback narrative.
Okay, so controlled company, significant insider selling. That definitely feeds into the risk profile. Let's formalize that with Chapter 6, risk assessment.
There are several layers of risk here. Let's start with the internal weaknesses and external threats.
Biggest weakness seems obvious. Scale. They're just tiny compared to the behemoths.
Absolutely. Expedia and Booking.com just dwarf them in marketing budgets and overall resources. It's an uneven playing field.
And the other big internal weakness has to be execution risk, right?
It's huge. You're trying to fundamentally change the behavior of a user base that's been conditioned for 2 decades to get your product for free, converting them to paid subscribers at $40 a year.
That's incredibly difficult. The churn rate could be massive. Customer acquisition costs could skyrocket. Many companies have failed trying similar transitions.
It's a notoriously tricky path. Success is absolutely not guaranteed, and any stumbles in execution will likely be punished harshly by the market given the current skepticism.
And the main external threat, beyond just the scale of competitors.
For me, the most critical future risk is technological disruption, specifically AI.
We touched on this earlier. AI getting good enough to replicate their human curation.
Potentially, yes. Travelzoo's whole moat, their unique selling proposition, is built on that human touch, that brand trust derived from expert curation. As AI gets more sophisticated at personalized recommendations, finding hidden deals, and even verifying value proposition at scale, it could seriously erode the perceived value of Travelzoo's core offering.
So their bet is essentially that the human verified trust element will remain valuable even as AI improves.
That seems to be the bet. It's a race between their brand loyalty and the pace of technological advancement.
And on top of all that, we have the broader economic picture for 2025.
Yeah, the macroeconomic headwinds are real. Persistent inflation, higher interest rates, that generally leads to more cautious consumer spending, particularly on discretionary items like travel. People might save more, travel less, or hunt for even deeper discounts.
Which could pressure Travelzoo's ability to both sign up members and get attractive deals from partners.
Exactly. And then you layer on geopolitical uncertainty, tariffs, global instability, conflicts. It creates what some call weaponized uncertainty. It dampens consumer confidence, makes travel planning riskier, and can disrupt the travel providers Travelzoo relies on.
Okay, quite a few risks to consider there. Let's try to bring this all together. Chapter 7, conclusion.
So Travelzoo is clearly at a major inflection point. You've got this strong, trusted brand built over decades, colliding head-on with intense market pressures and internal challenges.
Let's recap the bull case quickly. You've got a deeply discounted valuation, that PE of 10.8 versus peers in the 20s. You have exceptional profitability and capital efficiency, shown by that high ROIC and strong free cash flow. You have a net cash position on the balance sheet, and you have a clear potential growth catalyst in this pivot to a paid membership model, leveraging that trusted brand.
That's the bull case in a nutshell. High quality, cheap price, clear catalyst.
Now, the bear case. Formidable competition with vastly superior resources. Huge execution risk in making this difficult pivot from free to paid history is littered with failures here. And overshadowing everything is that serious red flag. The persistent, significant insider selling from the controlling shareholder, which directly contradicts the company's own share buyback program and raises major governance questions.
And that brings us back to the valuation summary. Our intrinsic value model still points to that $18 to $26 range. The potential upside from the current $9.76 is undeniably enormous.
But getting there is the question.
Absolutely. This is the very definition of a high-risk, high-reward investment. Success seems to hinge almost entirely on 2 things. 1, management's ability to navigate this incredibly difficult strategic pivot flawlessly, and 2, somehow reconciling or overcoming the market's deep skepticism, which is heavily fueled by that apparent conflict of interest with the controlling shareholder.
So a final provocative thought for you, the listener, to mull over. As AI continues to advance, if it reaches a point where it can perfectly mimic or even surpass human curation in finding and verifying travel deals, What actually happens to the trust economy that Travelzoo has spent 2 decades carefully building? What's the long-term value then?
Something to think about. And just a reminder, as always, this analysis was generated by an AI system. It's intended for educational purposes only and should definitely not be taken as financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. Hey, if you found this deep dive valuable, please hit that like button and subscribe to Stock Analytics AI. Remember, for just €4.99 a month, members get priority requests for deep dives on specific tickers. Plus, over the next few months, we're systematically covering all of the S&P 500 stocks, and members get exclusive access to that rollout. If you just want a one-off deep dive on a stock you're watching, drop us a super thanks.
Thanks for tuning in.
We'll catch you on the next deep dive.